The US economy is entering a very strange phase. For years, the Federal Reserve had a fairly straightforward playbook. If inflation was running too hot, it could simply raise interest rates. If the economy started slowing down too much, it could simply lower them to stimulate growth. Historically, those tools have given the Fed enormous influence over the direction of the US economy. But this time feels different. The latest economic data suggests we may be entering a period where neither option solves the problem. Hiring is beginning to slow down, and inflation remains stubbornly elevated. And, for the first time in quite a while, the Fed's two biggest responsibilities appear to be pulling in opposite directions. Welcome back, everyone, to Lunch Money Investing, where my goal is to both document my investment journey to $1 million investing my lunch money and also keep you informed on market events. Today, we're going to be breaking down the latest labor market data, what it means for interest rates, and one earnings call that quietly reinforced why inflation may stick around longer than many investors expect. And most importantly of all, how all of that impacts your lunch money. Now, before we wrap up the labor market section, there's one statistic buried inside this week's data report that I think many investors are overlooking, but it may end up being one of the most important numbers released all week. Let's dive into it. Let's start with the first piece of the puzzle. The Conference Board's Consumer Confidence Index came in at 91.2, missing expectations of 94.4. While that may sound like just another economic statistic, it matters because consumer spending accounts for roughly 70% of the US economy. Of course, AI might be an ever-growing part of our economy, but as of today, consumers still rule, and right now, the data suggests consumers might be losing confidence. And when consumers become less confident about their financial future, they often pull back on discretionary spending. That slowdown doesn't happen overnight, but confidence surveys can provide an early glimpse into where the economy may be heading. By itself, this isn't enough to sound alarm bells, but it becomes more interesting once you look at the rest of this week's data. This week, the labor market told a similar story of weakness. Private payroll processor ADP reported that employers added just 98,000 jobs during the month of June. This was down from 118 from the previous month and well below economists' expectations of 122,000. Then came the government's official jobs report. Non-farm payrolls increased by only 57,000 jobs, roughly half of what Wall Street had expected. The weakness initially caused stocks to jump in the morning in hopes of Fed easing, but that hope faded throughout the day. To be clear, neither report suggested the labor market is collapsing today, but together they do suggest hiring may finally be losing some momentum after remaining remarkably resilient for much of the year. Interestingly, there was one headline in the report that initially looked encouraging. The unemployment rate actually declined from 4.3% to 4.2% for the month of June. At first glance, that sounds like exactly what investors want to see. But remember that statistic I mentioned at the beginning of the video? This is it. The reason unemployment fell wasn't because millions of Americans suddenly found jobs. Instead, the labor force participation rate declined from 61.8% to 61.5%. Here's why that matters. The unemployment rate is calculated using only people who are actively participating in the labor force. If someone loses a job and continues searching for work, they're counted as unemployed. But if they stop looking for work altogether, whether because they retire early, return to school, or simply become discouraged, they're no longer considered part of the labor force. They drop from the denominator. That means they disappear from the unemployment calculation entirely. So this month at least, part of the decline in unemployment came from fewer people participating in the labor market. Not necessarily because substantially more people found jobs. And that's a much more nuanced picture than the headline unemployment rate alone would suggest. And that's exactly where the Federal Reserve's problem begins. And that might explain why the market faded throughout the day. Normally, weaker employment data would make it easier for the Fed to lower interest rates and support the broader economy. But inflation has other plans. Recent inflation data continues pointing in the wrong direction. Core PCE, which is the Fed's preferred inflation gauge, remains well above its 2% target and has recently shown signs of acceleration rather than continuing its gradual decline, as many would have hoped. During recent comments, Federal Reserve officials again emphasized that restoring price stability remains their number one priority. And that's understandable. If inflation remains elevated for too long, higher prices begin working their way into wages, contracts, and business planning, making inflation much harder to eliminate and more entrenched. So now the Fed finds itself caught between two competing realities: a labor market that's beginning to soften, and inflation that still hasn't been fully brought under control. But inflation data wasn't the only place this showed up this week. One company quietly reinforced the inflation narrative during its earnings call, and surprisingly, that company wasn't one of the AI giants. It wasn't Nvidia, it wasn't Microsoft. Instead, it was General Mills. The company behind beloved brands like Cheerios reported better than expected earnings and revenue growth in its most recent quarter. That sent shares higher after the announcement. But the earnings beat wasn't what caught my attention. Instead, during the earnings call, Chief Financial Officer Kofi Bruce said the company expects input cost inflation to run between 4 and 5% of the cost of goods sold during fiscal 2027. Think about what General Mills buys every day: agricultural commodities, packaging, transportation, energy, labor. These are the kind of costs that directly affect products sitting on grocery shelves around the country. So, when a company like General Mills tells investors it still expects meaningful cost inflation heading into next year, that's another reminder that inflation pressures haven't completely worked their way through the economy. Now, that's just one company, and we shouldn't draw sweeping conclusions from a single earnings call. But when you combine that with this week's macro data, it becomes yet another piece of the same puzzle. Putting everything together, and you can start to see why investors are paying such close attention to the Federal Reserve. Consumer confidence is weakening, hiring appears to be slowing, yet inflation remains stubbornly high and above the Fed's target of 2%. The Federal Reserve has a dual mandate: maintain price stability while supporting maximum employment. Most of the time, those two goals have some sort of tension, but right now, they appear to be going in opposite directions. Now, before wrapping up, as usual, here's a quick update on the Lunch Money Investing portfolio. The portfolio currently sits at $2,718, up 1.48% compared to the previous week, narrowly outperforming the S&P, which gained 1.43% for the week. Leading the portfolio was crypto, up 5%, followed by gold, which gained roughly 2.3%. The biggest losers this week were equity momentum ETFs, down just over 5%, followed by systematic trend following, which slipped around 2%. Overall, this was just another reminder of why diversification matters. Leadership continues rotating across the market, and different asset classes are taking turns carrying the boats. So, given the data and what you see in your economic reality, does the Fed have an impossible task in front of it? Or do you think this Fed can thread the needle and get us back on track? Let me know down in the comments below. And as usual, if you found this video informative or just generally interesting, please be sure to smash that like button, and of course subscribe to the channel to see more content like this. And as always, protect your lunch money.